All right, so now the rest of the next 3 pages break through each method with both periodic and perpetual methods attached to them. The perpetual method here, starting off, right, remember that when we're looking at the sales log and we're invoking the perpetual method, when we're doing that, we have to stop at the point of sale and calculate what we just sold based only on what I have so far. So don't use forward-looking information when you're using the perpetual method. So for example, I made a sell on 110x6 here, right? January 10th, I made a sell. Well, I don't know that I'm going to get more units on the 25th at $9 and more units on the 29th at 10. I don't know any of that on this date. So don't use any forward-looking sales information or purchase information when you're using perpetual. This is happening in real time, so we can only consider January 10th and the transactions that came before. So COGS using average cost under a perpetual basis is what we're calculating. And the very first sell we make is on January 10th. We sold 1,000 units. Now, I don't give you sales information here, like how much they sold each unit at. Of course, the sell would be journaled something like cash or accounts receivable, depending on whether it was a cash sale or a credit sale, and sales revenue, right? We would have some dollar value debited and credited. But what I want to focus on now, of course, is the cost of goods sold entry that we match to that sale. And we're matching it on the day of the sale because, once again, we're using the perpetual method. So anytime we make a sale, we determine, well, what was the cost of what we sold and how much should I reduce my inventory because I just made that sale? So I sold 1,000 units. And if I'm using the average cost method, that means that I want the average cost of my units, right? But I'm only going to consider the units I have as of January 10th. So what is the average cost of 110 units? Well, it's going to be a weighted average. I have 200 units that are $7 a piece. So that is $1,400. But then I also have 11. So then I'd be like, okay, well, then I also have 1,100 units. But wait, I don't have 1,100 units. Remember, I returned 70. So I only have 1,030 of those units remaining that I kept. And those are going to be at a price of 834 per unit. So this would be the total value. This is my total dollar value of inventory. And I'm going to divide that by the number of units that I have at January 10th. Well, I had 200. None of these were returned. This is just what I began with. So we're going to take those 200 units, and we also have 1,030 units that we did not return from the purchase we made on January 8th. And so this is the denominator, just the total units in my inventory at January 10th. And then we just need to keep doing these calculations. 200 times 7 gives me the $1,400 here. And we're going to add to that 1,030 times $8.34. I did that when I was showing you how I got to the price per unit and how I could project what this purchase did overall to my inventory account. And it was $8,590.20. And then adding the denominator pieces together, 1,230, or not dollars, units. So I have total dollar value of inventory divided by my total units. And it comes out to a number that isn't clean. It has a lot of digits, right? But I can round it to the nearest cent. And you don't have to round in your work, just show me the work. And then I can figure out, I'm not really looking at this as much as I'm looking at what you included in determining it. But this is my average cost at 110. Don't need to rewrite it. $8.12 per unit. So now we just apply that average cost per unit to the units we sold. We sold 1,000 and we multiply that by $8.12. So in total, I would judge the cost of this cell at $8,120. And that would be the cost of goods sold on January 10th. Remember, COGS is an expense. It reduces net income. It is the expense of the inventory that I had purchased, and I reduce assets when I credit inventory. So, but that's just one cell. Now we have to consider the sell at the end of the period on January 30th. So on 130, I sold 500 units. And we need to figure out what the average cost of the 500 units was that I sold. Well, we had two purchases since the last sale we accounted for on January 10th. We purchased 350 at 9 gross price, 400 at 10 gross price. We also have an average cost of everything prior to the January 10th sale. So when we come up with our moving average and ask ourselves the same question, like what is the average cost of units at this point? And that was January 30th. The first thing that I would look at is how many units are left at $8.12. Because I had 1,230 units at January 10th, and I used that to figure out how much the cost per unit on hand was. But then I went and sold 1,000 of those units. So if I sold 1,000 of these, I have 230 left at that price of 812. That is the very first inventory value that I need to put into my moving average. Then I can add in the new ones that I purchased on January 25th. I purchased in what I kept 330 at 923. And I also had 400 because I had no returns, 400 at 1030. And then the number of units I had available, well, started with the 230. Those were the ones that were left unsold after that first sell on January 10th. My purchase added 330 more, and the final purchase of the month added 400. So now I'm going to do the same thing and do some calculations here. 230 and 812, 1,867 and 60 cents plus 330 times 923 plus 400 times $10.30. This is the total value of all of the inventory that I first was left over with after the first sell, plus I purchased, and then add the total number of units I have at that date, and 960 units available. So this is my total dollar value divided by units. So if I add the numerator up, I have $9,033.50. It's the total value of all those guys. And I divide that by 960 units. I get a price per unit of, if I round, $9.41. And again, I rounded that to the nearest cent, but you don't have to. I'll just look at your inputs to figure out whether you're doing this correctly. So $9.41. And now I can just simply apply that average cost, right? It took a lot of meticulous math to get there, but once I have it, it's just taking the sold units and multiplying them by the amount that I have as an average cost. So 500 times $9.41 is $4,705. That's the amount of cost of goods sold I would assign and the amount that I would reduce my inventory by due to the units that are no longer mine through sale. So that reduced net income, and that will also reduce my assets by the credit to inventory. Of course, too, there would be either cash or accounts receivable and sales revenue, but I don't give you the sale price. But just understand that, of course, this would be part and parcel of recording cost of goods sold under the perpetual system, because as soon as we record revenue, that very same day, we need to record cost of goods sold. So the total cost of goods sold for this period would be the 8,120, and add to that the 4,705. And that is 12,825. Now, if that's total cost of goods sold, now what is ending inventory? Right, so to determine the ending inventory, remember the average cost, under average cost, the average cost of my units is 941. And I had 960 available according to my purchase and my sales and my returns. And I sold 500 of them. So the number I would have remaining is 460. And that happens to exactly equal the number of units I counted on hand. So there was no discrepancy between just taking the units purchased that I actually kept, right? 200 was my beginning inventory. 1,030 came because I purchased 1,100 and I returned 70. So now I only have 1,030 left. So this denominator was always just the number of units that were there that I hadn't returned. After I made the first, calculated the first average cost, I sold 1,000 of these. It left 230 left. I added more that I didn't return, 330. Added more I didn't return, 400. That got me to 960. I sold 500. So now I have 460 left. So according to the purchase sell logs, I should have 460 units left. According to the physical count, I should have, again, 460 units left. And this would mean that there is no shrinkage. So none of them were stolen, lost, ruined, anything like that. We don't have to worry about the shrinkage calculation. When we have no shrinkage, then we can turn to a really nice relationship that all of the goods I had available for sale, and remember, the goods available for sale are made up of my beginning inventory plus any purchases I made, net of any discounts or returns or freight. That equals cost of goods sold plus ending inventory. Okay, so you can use this in certain cases to make your job pretty easy. In this case, with the average price per unit and knowing that we have exactly 460 units remaining, right, and that that was appropriate, in order to determine the total ending inventory, the amount that we would see in our T account at the end of the period, the dollar value we would see, we would just take the 460 and multiply it by the average price per unit, which is $9.41. And we have $4,328.60. This is my average ending inventory. I'm sorry, yeah, my inventory, that's the end of my T account based on the average cost method applied under a perpetual system. This is the cost of goods sold. And with these two, I could actually come up with gaps. I could figure out how much goods available for sale I had, if I needed it for any reason. So that's the average cost perpetual method. Now, this is the most mathematically tedious cost flow method. So, understand that this is a lot. Um, if I had this on the test, I wouldn't do it with this many purchases and sales because it just takes a while to calculate. Right. So the next video we'll talk about FIFO, and then the video after that we'll talk about LIFO, cost of goods sold.